I have a confession to make to start off this deep dive.
Oh boy. Okay, let's hear it.
So it started like any other month, right? I opened up my trading app just to check my portfolio, which is, something I had been doing with a quiet sense of pride lately.
Uh-huh. Because it was going well.
Exactly.
Uh-huh.
I was up about 80 pounds. I mean, nothing dramatic, obviously, but it was enough to make me feel kind of clever. Like enough to make me think, hey, maybe this investing thing is easier than everyone says it is.
Oh, that's always a dangerous moment.
Right. And then the news cycle completely flipped. Suddenly there are all these headlines about Iran and oil prices are spiking.
Uh-huh.
And these analysts on the news are throwing around these terrifying terms like stagflation and regime shift.
Right, which, are terms specifically designed to sound alarming.
They really are.
But just to demystify those quickly for you and for the listener, stagflation is really simply an economy experiencing stagnant growth at the exact same time as high inflation. So things get more expensive, but wages and economic output they don't grow.
Right, it's like the worst of both worlds.
Exactly. And a regime shift just means the fundamental macroeconomic rules we've been used to, like a decade of nearly 0% interest rates, are suddenly changing to a new normal.
Yeah, and hearing all that, my brain immediately went into panic mode. So I opened the app again, and, well, that familiar, comforting green number had just turned red.
Oh, man.
Yeah. Within days, I was down 123 pounds. And it eventually peaked at nearly 200 pounds down.
Right.
And I know it wasn't a fortune, but it was mine, And watching it disappear gave me this visceral, sinking feeling. It felt exactly like standing on a train platform, just helplessly watching your train leave without you.
It's an incredibly helpless feeling, but you are far from alone in that. And honestly, that moment, looking at a bleeding portfolio, is exactly why we are doing this deep dive today.
I really hope so, because it was rough.
It is, and we want to speak directly to you, the listener, who might be staring at your own red screen right now, feeling that exact same knot in your stomach, because we're diving into Gregory Szkola's audiobook, The Crisis Playbook.
Yes, the Playbook.
And as a mentor, my goal for us today is to take that sheer panic, that feeling that you are enduring some sort of mysterious punishment from the universe, and transform it into an understanding of explainable market mechanics.
Man, moving from mysterious punishment to explainable mechanics is exactly what I need. Because when my portfolio dropped, my absolute instinctual reaction was to feel personally targeted.
Yeah, the why me phase.
Literally, I was sitting there asking, why is this happening to me? Is my entire strategy broken? It genuinely feels like the market has singled you out to take your money.
Well, here's the first psychological shift we really need to make, and it's realizing that you aren't special, and neither is your loss.
Ouch, but fair.
I mean it in the best way. When we look at the actual data from the spring crisis outlined in the playbook, we see the reality that the headlines simply do not tell you. The broader market was down too.
Right.
In fact, at the absolute peak of the crisis, when fear was at its highest, the global stocks benchmark lost 12.1%. However, the author's portfolio, the strategy they were actually using, only lost 6.4%.
Okay, let's unpack this, because my immediate reaction to that stat is I've got to give a bit of pushback.
Go for it.
A 6.4% loss still feels terrible. I mean, it's like feeling devastated about getting a D on a math test, and then someone comes along and says, hey, don't worry, the class average was an F.
Right.
Like, that doesn't change my grade,
Yeah.
and it certainly doesn't put the money back in my pocket. So why does that difference actually matter?
I completely understand why it feels like cold comfort in the moment. I really do.
Hmm.
But that avoided loss of 5.7%, that is the ultimate proof that your portfolio is actually working.
Even when I'm losing money.
Yeah. Yes, even if individual assets within it are falling, let's look at why this matters immensely as you scale up your investments.
Okay.
If you have a smaller, maybe 10,000 pound starter portfolio, outperforming a bad market by 5.7% saves you about 570 pounds. Right.
Yeah, so maybe a weekend getaway.
Exactly. But if you apply that exact same percentage to a sizable 500,000 pound retirement portfolio, that outperformance saves you 28,500 pounds.
Oh, wow. Yeah, that's real money.
It is. The key takeaway for you here is this. Never compare your portfolio to your hopes. Compare it to the market. You shouldn't expect every single hedge to work perfectly, but you should expect the portfolio as a whole to do its job.
Which is preserving capital relative to the rest of the world.
Exactly.
Okay, so the D on the math test isn't just a grade, it's capital preservation. I get that. But preserving capital against a massive drop still leaves me wondering why the drop happened at all. We talked about explainable mechanics, so let's look at the engine. What actually broke during this crisis to drag the whole market down?
To remove the mystery, we have to look at the specific mechanics. First, we saw the breakdown of traditional hedges.
Right.
For decades, the classic 60-40 portfolio, 60% stocks, 40% bonds, has relied on a specific mechanism.
Right. Usually when stocks fall because the economy looks shaky, investors flee to the safety of government bonds, right?
Exactly. And that demand pushes bond prices up. They act as a cushion. But in this specific crisis, that relationship just fractured. Bonds fell alongside stocks, dropping 3 to 5% themselves.
Wait, if bonds are the cushion, why did the cushion deflate at the exact same time as the stocks?
Because of inflation, and more specifically, the interest rate hikes used to fight it.
Okay.
When inflation spikes, central banks raise interest rates. When new, higher interest rates are issued, the older bonds sitting in your portfolio, which pay a lower, older interest rate, suddenly become much less attractive to buyers.
Oh, so their value just drops.
Exactly. And at the exact same time, those higher interest rates make borrowing money way more expensive for companies, which stunts their growth and causes their stock prices to drop.
So the very tool used to fight inflation ended up simultaneously hammering both the stock side and the bond side of the portfolio.
You got it.
Man, that makes the regime shift concept make a lot more sense. The old rules of stocks and bonds balancing each other out just stopped working because the underlying cost of money changed.
Precisely.
And on top of that, tech and growth stocks, which are heavily represented in the major indices, they just plummeted.
They did. But what's fascinating is how the author frames this in the Playbook. They refer to that massive drop in tech and growth stocks not as a flaw in the system, but as a feature, not a bug, of owning growth assets.
That phrasing completely shifted my mindset. I was looking at my tech stocks tanking and thinking, like, I made a catastrophic error in judgment.
Right, you think you picked the wrong things.
Exactly. But the playbook points out that growth stocks are valued based on their massive potential future earnings. So when economic uncertainty hits or interest rates rise, those future earnings look a lot less guaranteed.
Right. So investors naturally rotate out of them and into safer, more immediate value.
So getting hit hard during a panic isn't a glitch. It's just the expected behavior of that asset class.
Exactly. It's the expected volatility you accept in exchange for their long-term growth potential during the good times. But beyond the tech drop and the bond failure, there was another factor at play.
The hidden dagger.
Yes, what the author calls the hidden dagger of the crisis. And that was the strength of the U.S. dollar. When global tensions rise, money invariably flows to the U.S. dollar as a perceived safe haven.
Now, I have to admit, I had some confusion on this point when I was going through the source material. Isn't gold supposed to be the ultimate safe haven during a crisis?
Usually, yes.
Because the source mentions that Pi 5, which is the gold holdings in the portfolio, got hit really hard. If people are panicking, shouldn't gold go up? I'm guessing this has to do with how these assets are actually priced on the global stage.
You hit the nail on the head. It all comes down to the mechanics of pricing. Gold is priced globally in U.S. dollars.
Okay.
Because of that, there is an inverse relationship. Think of it like a seesaw. If the U.S. dollar side gets significantly heavier and stronger, the gold side goes down.
Oh, I see.
It takes fewer of these newly strengthened dollars to buy the exact same ounce of gold, which means the price of gold drops. During this crisis, gold fell 8 to 10% purely because the dollar surged.
So it's not that gold suddenly lost its intrinsic value or that investors stopped believing in it. It's literally just a currency conversion mechanic.
Precisely. And that strong dollar didn't just hit gold, it also hit global consumer staples.
Which is referred to as Pi 4 in the book, right?
Yeah, exactly. Pi 4 fell 7 to 9%. We can think of this like an automatic exchange rate tax. If a U.S.-based consumer goods company is selling soap and toothpaste in Europe, they're getting paid in euros.
Right.
But when they bring that money back to report their quarterly earnings and the euro is weak against a strong dollar, those European profits translate into fewer U.S. dollars.
Oh, wow. So their balance sheet looks worse, not because they sold less soap, but because the currency they sold it in lost ground to the dollar.
Exactly.
That is exactly the shift from mysterious punishment to explainable mechanics I was talking about. The market isn't a monster hiding in the dark trying to steal from me. It's just repricing things based on a currency seesaw and exchange rate conversions.
That's a great way to put it.
But, knowing that doesn't completely fix the problem
No, it doesn't.
because seeing the actual monetary value drop still really stings. Percentages are abstract, but when I look at my screen, I don't see negative 6%. I see real purchasing power vanishing. How does a rational investor handle the sheer terror of those actual numbers?
This is a crucial transition because understanding the math only gets you so far. You have to manage your own human psychology.
Yeah,
The reality of zeros changes everything. Your 123-pound loss was annoying, but, manageable. But applying that exact same 6% drop to larger portfolios entirely changes the psychological weight, even though the mathematical mechanism is identical.
right. 6% of a beginner's account is a weekend trip. But a 6% drop on a 50,000-pound account, that's over 1,600 pounds.
Right.
That's a proper holiday gone.
Exactly. And on a 100,000-pound portfolio, it's over 3,300 pounds. That's a secondhand car.
And if you've got a 500,000-pound retirement portfolio, a 6% drop is 30,000 pounds. That is a whole new kitchen.
Yes, the percentage stays exactly the same, but the emotional impact scales up drastically. The panic is profound because our brains just aren't wired to ignore 30,000 pounds evaporating.
No, definitely not.
And this is where we have to confront our cognitive biases, specifically loss aversion. Human beings are biologically wired to feel the pain of a loss about twice as intensely as we feel the pleasure of an equivalent gain.
Which explains why losing 30 grand feels like a physical threat.
Absolutely. This is why the author of the Playbook draws a massive, thick line between volatility and loss. We see this in Commandment 8 and Commandment 1 from the 10 Commandments of Crisis Investing.
Yeah, that distinction blew my mind. The idea that you must remember volatility is not loss. Volatility is simply short-term price movement. It is the necessary price of admission you pay to be in the market.
Right.
A stock drops 20%, and then over time it recovers. That is volatility. But loss, actual permanent capital destruction, only happens if you commit the ultimate sin of investing.
Which is panic selling.
Exactly. Because selling during a panic is what transforms temporary volatility into permanent damage.
Right. You only actually lose the money if you hit the sell button while the asset is down. If a stock drops 20%, you sell it, and it eventually recovers in the market. Well, it doesn't recover in your portfolio because you no longer own it.
So when you panic sell, you aren't actually cutting your losses.
Yeah.
You are just locking them in.
Exactly.
You're literally choosing to exit the market at the exact moment when future expected returns are at their absolute highest because everything is currently on sale.
Yes. The rule of thumb here, from the mentor's perspective, is simple but profound. Never make a portfolio decision when your heart rate is elevated.
That's good advice for life, honestly.
It really is. The underlying strategy doesn't change just because the numbers on the screen have more zeros. Your personal psychology has to evolve to handle those zeros.
Okay, so let's say I'm sitting on my hands, my heart rate is up, but I am forcing myself not to sell. I understand the mechanics of the bond failure, I see the dollar seesaw, and I know not to lock in capital destruction. But just staring at the red screen feels terribly passive. How do we put this crisis playbook into action while the storm is actually happening?
Well, we look at the rules of engagement for navigating the dip. And the most actionable of these remaining commandments, Commandment 2 and 6, is the superpower of continuous monthly buying.
Okay, how does that work?
If you have a system where you make a fixed monthly contribution, say 1,000 pounds during a market dip, that same amount of money automatically buys you 3 to 4% more shares than it did the month before.
Oh, right, because they're cheaper.
Exactly. You aren't trying to perfectly time the bottom of the market. You are simply showing up and acquiring assets while they are on discount.
And that ties perfectly into how we handle rebalancing. If your portfolio gets totally knocked out of whack because tech dropped and energy spiked, the traditional instinct is to sell the winners to buy the losers just to get your asset percentages back to your target.
Right, but the playbook says to use your new monthly contributions to fix the balance instead.
That makes so much sense.
It does. Using new money is your best tool for fixing a misaligned portfolio. Think about the mechanics of it. Buying to rebalance means you are accumulating bargains with a very low emotional cost.
Well, selling your existing assets to rebalance just locks in those painful losses and creates friction.
Exactly.
But wait, what about the assets that are actually going up? During this crisis, while everything else was bleeding, The source notes that defense stocks went up 5 to 10%, and energy infrastructure went up 2 to 5%.
Yes, they did.
When you see that, the natural, overwhelming instinct is to rush out and chase the green numbers. You think, defense is working. Let me dump my bleeding tech stocks and buy more defense right now.
And this is exactly what the playbook warns against in Commandments 5 and 7. By the time a hedge like a defense stock or an energy asset is visibly working and making headlines on the nightly news, the price movement is largely already done.
So you're too late.
Exactly. The people who make money on hedges are the ones who owned them before the crisis started, not the ones scrambling to buy them at a premium during the panic. You have to own your umbrella before it starts raining.
Own the umbrella before the rain. I think that's the perfect way to look at it. But what if you did own it?
Okay.
What if you followed the rules, you held defense stocks as a hedge, and now they're up 30%? Shouldn't you take that profit while you can?
Well,
Because the playbook addresses this with a fantastic analogy. It says, don't cut your flowers to water your weeds.
it is a vivid way to put it, isn't it? The principle is to let your winners run. If you own an asset that is performing exactly as intended during a crisis, and the underlying geopolitical thesis haven't changed.
Like if the global uncertainty is still happening.
Exactly. If the uncertainty that caused defense stocks to rise in the first place is still very much ongoing, then let it run. Taking profits just because a green number looks nice can sometimes prematurely stunt the very hedge that is keeping your entire portfolio afloat.
Wow, this whole deep dive has been such a journey.
It's a lot to take in.
It is. I mean, we started with this image of me just staring at a red screen on a trading app, feeling personally attacked by the universe, feeling that mysterious punishment.
Right.
But by peering back the layers, we've walked through the global market mechanics. We've seen how inflation breaks the bond cushion, how the strong dollar acts as an exchange rate tax, and we've differentiated between short-term volatility and permanent capital destruction.
Yeah, that distinction is key.
It really is. We've reframed a market drop not as a time to panic, but as an opportunity to automatically buy cheaper shares.
It is a profound transition to make as an investor. And to fully synthesize this, we need to apply the final principles of the playbook, Commandments 9 and 10, which are about zooming out and trusting the process.
Zooming out.
Yes. Today, your screen might be red, and the loss aversion makes it feel like the end of the world. This month, your portfolio might be down 6%. But zoom out further.
Look at the 5-year chart.
Exactly. Look at a 5-year chart. Since you started investing, your portfolio is likely still up significantly, precisely because you kept buying through previous dips. You built your portfolio strategy for a reason. You knew macroeconomic crises would eventually come.
Yeah, intellectually I knew it.
Right. And now that one is here, don't abandon a sound strategy just because the mechanics of it are momentarily uncomfortable.
The process isn't supposed to feel good during a crisis. It's just supposed to keep you in the game long enough to benefit from the eventual recovery.
Perfectly said. Which leaves us with a final provocative thought to consider. We've talked extensively about how a market crisis tests your portfolio's mechanics, whether your hedges work, whether your bonds cushion the fall.
Right.
But more importantly, a red screen acts as a brutal stress test for your own self-control. So ask yourself this. If you are standing on that metaphorical platform, watching your portfolio drop, what does your immediate, visceral reaction today tell you about your true risk tolerance for tomorrow?